Good morning. Welcome to the Plato Income Maximiser Shareholders Conference. Your host today is Dr. Don Hamson, Company Director and Managing Director, Plato Investment Management. Go ahead, please, Don.
Thanks. Good morning, investors. We're here to discuss the half-year results for Plato Income Maximiser. It was an interesting 6 months, actually. It was a tough time for investment markets, particularly in the last quarter, but it was actually a very good period for dividends. And so as an income maximiser, the portfolio actually did generate substantially more income than it did in a normal period, and we'll talk about some of the reasons for that. But in terms of performance, you can see it was a pretty tough period. On page 4 of the slide pack that has been sent out, the portfolio lost 4.8% for the half year, but that was pleasingly 1.3% ahead of the market, which actually fell 6.1%. And these are all numbers that include franking credits. So we actually had a solid year, or half year and full year of performance, and that has helped us get back to square with the index since inception after fees. So we're now right dead in line with a 3% index return since inception. So it's good to see that coming back, given the initial period of tough performance for many of the income stocks in sort of the first 12 months of Plato Income Maximiser. The longer-term numbers are still very strong, and you see that on slide 5, the longer-term performance of the underlying portfolio of investments, because Plato Income Maximiser actually does invest into the Plato Australian Shares Income Fund. You can also clearly see, though, the retracement of markets, how strong it was in that last 3 or 4 months of 2018. But as I mentioned, dividend yield has been strong. If we actually look at the next slide, shows the dividends that were paid out during the year, and it was 5.7%, and cash yield and another 2.4 on franking. So that was a pretty strong result, the realised yield for the fund, and it is now delivering substantially more than the market, which was 4.3 cash and 1.4 franking credit for the year. So a comfortable beat on the income there. And directors have continued to declare dividends. We paid 6 half-cent fully franked dividends, and these are franked at 30% in the first half of financial year 2019. Subsequently, the directors have also declared 3 more half-cent fully franked dividends for the March quarter. The January one has already been paid. And in addition, the directors resolved to pay at least a special dividend of 1 cent per share on the 31st of March, because we have received more income, and also to beat the potential, and I do say potential, ALP proposal on franking. That was, in fact, one of the main reasons to pay out a special dividend. We'd normally probably want to pay larger dividends each month, but because of the ALP proposal, which starts from, or if they come in and get this through Senate, they expect it to start 1 July, so we need to pay those dividends. Now, there is some potential for that 1 cent dividend to actually increase. The directors, currently there are options outstanding. In fact, that's the next slide, does talk about these options. So there are still about nearly 300 million options that are outstanding. They expire on the 29th of April this year. Currently, they're out of the money. The strike price is $1.10, and the stock is trading substantially below that level. But should the stock price rise a little bit, quite a bit in the next month or two, there is still potential for some of those options to be exercised, and that would obviously increase the amount of special dividend we'd have to pay. But if none of the options exercise, which is a reasonable guess at the moment, then the directors may resolve to actually increase the size of that special dividend. And that announcement will be made in certainly no later than early May, so that given the timing of that dividend would coincide with the May monthly dividend. So, just keep the options in the back of your mind. From an NTA performance point of view, you can see how tough the market environment was. We started the 6 months at basically $1.10. Market falls brought that down by almost 8 cents, and we paid essentially 3 cents worth of dividends. Please note the NTA chart here doesn't include franking credit, so it to some extent understates the value really of the company. And we finished the year just below $1 on NTA. I would say, though, pleasingly, the market has been quite strong in January and February so far, And in fact, the NTA has gone back to about $1.06, so it's actually had a substantial rise. So the share price is currently trading a little discount to NTA, and should it actually, come back towards NTA, then there may be some chance of it exceeding $1.10 by the end of April. Now to turn to, I suppose, the results in more detail in terms of stocks and things and more our manager outlook. If we move to slide 11, as I sort of mentioned, it has been a tough period the last half of last year for total returns. But in the quarter, the market fell about 8% in the December quarter. All the things that were worries at the time, and they all seem to, come together in that final 4 months of 2018. The fears about rising interest rates in the US, reductions in global liquidity, as we've talked about quantitative easing for years now, but now that's been starting to unwind, particularly in the US, and if you like, quantitative tightening is starting to happen, which means long bond yields are rising a little bit. There was certainly signs of slowing economic activity, less so in the US. US is still going gangbusters, but Europe had quite a soft half. I mean, there was actually a negative growth quarter in Germany and in Italy. Obviously, got Brexit fears, and here in Australia, we've seen a very soft housing market, and that's flowing through to retail sales. And for instance, car sales fell significantly last year for the first time in a number of years. So, there is evidence of a slowing economy, and of course, we still have the tit-for-tat trade war between the US and Japan. So all these things seem to come together in the final quarter, and the markets fell quite heavily. The silver lining, I think, out of this is that the markets are no longer fearful of rising interest rates. Pretty much both here and in the US and everywhere else for that matter, the markets are now discounting further rate rises. They're basically saying, in fact, our own RBA has come out and said that we're back to neutral policy. They had been on a tightening bias here in Australia for the last number of meetings, but the RBA here has moved back to a neutral bias, meaning there's just as much of a chance of a rate cut in Australia as there a rate rise. And so too have some of the Fed directors come out and basically said they're on hold or on pause. So it looks like the interest rate tightening cycle in the US has come to a pause, maybe a close. And there were some great opportunities for income, though, in last or particularly quarter, but the last half year, we saw some very large dividends, structured dividends, the off-market buybacks by BHP and Rio, and we participated in both of those, and they were very valuable, particularly for low-tax investors, such as retirees. And we had good stock selection in areas such as financials and consumers. I mean, I think a great chart that highlights the change in interest rate expectations is a chart that I took from Macquarie. So this is a Macquarie macro strategy chart. It just looks at RBA rate expectations over the last sort of 18 months or 15 months. And if you go back to December 17 or June 18 or even November 8 last year, the expectation, the lines there were that the next move in interest rates would be up. And just between November and now, basically you've seen those expectations roll over to, if anything, now the market is thinking the next rate move by the RBA might actually be down, even though the RBA itself has gone to a neutral pause. You can see how that rapid turnaround just in the last 3 or 4 months means that markets are not worried about rising interest rates, and I think that's, as that is sort of, that word has got around in markets, if you want to put it that way, that's one of the reasons why I've seen quite a strong rally. In fact, on Friday, the Dow Jones hit 26,000, retraced it, and finished 9 positive weeks in a row, so it's actually been a pretty strong run to start the year. If we look again at the sort of outlook, income is still pretty hard to find from a lot of the typical. This is on slide 13. Some of the typical asset classes with interest rates on hold here. You're seeing that term deposits are stuck around the 2% mark. Maybe if you can get a good one at 2.5%, but this is the RBA indicator says just over 2%. Long-term bond yields have actually fallen, in that December quarter, and so they're back to actually below where they were this time last year, so 2.3%. because markets fell, we've actually seen a little rise in our, now these are our forecast levels, so these are our expectations of the average yield you'll get this year, or really the starting yield. And because markets have fallen, then both global equities have risen a little bit from just under 2% this time last year to just over 2% in yield. REITs are 5%, and the Australian market, we expect, if at least at the start of the year, obviously the market's rallied and the yields have gone down a little bit, we expected at the start of end of December or start of January, the yields are just over 6%, including franking here in Australia. So, mentioned before, it was a great period for income. On slide 14, we just provide some of the stocks where we picked up extra income. This is actually for the full year, but much of it happened in the second half of the year. No surprise that we buy banks and get more income from the high-yielding stocks like the big four banks. They're at the top of the list, but some nice dividends from the likes of Rio and BHP and Woolworths and Macquarie coming through as well. But the big one to note there, it's right at the bottom, is the off-market buybacks. So these very large buybacks by BHP and Rio basically added about 5% to income for the year. And that means that, if you get that, and that was, these are once-off sort of levels of income, so you don't expect them every year. But what it does mean that, we expect roughly our portfolio to generate about 9% income. But if you get 5% from these buybacks, then our forecast really, if you like, for this financial year is for the underlying investments to get more like 14%. And that's one of the reasons why we're able to pay a special dividend, because we're getting more income than normal. And they're all fully franked, those buybacks. In terms of performance and where did we, so that explains the income, but where do we get the actual outperformance of the index? Well, we had, again, strong contributions from some of those stocks that were good income stocks like BHP and Woolworths. We had a strong contribution from basically not owning AMP. I mean, clearly some areas of financial services are under a lot of pressure from the Royal Commission, and AMP has certainly been one of those. And, basically we bought it and had the dividend early last year and then sold out of that stock completely. And so it more than halved since the start of last year, and not owning it has added 45 basis points. So that's, often you win by not losing, and avoiding the landmines. And Myer's another one. It's a dividend trap, and we see these stocks as being dividend traps, and avoiding them is a good way to save your capital, if you like, because we are trying to protect capital as well as get income. Other good stocks. Actually, we rotated through a couple of the banks like CommBank and Westpac, and they were on the list that had a good long-term position we've had for a number of years in Macquarie, and it keeps delivering. Another couple that we avoided in our top 10 were the likes of Lendlease and Origin. Qantas was also a good stock, as South32. So we do actually have a liking for many of those resource stocks, and that continues. I would say that it's not in this half, but we've already received a large special dividend from BHP, so it was virtually worth another normal annual dividend. So, the dividends keep coming, and a number of companies are also paying specials. Mentioned before about winning by not losing. Well, Myer was a classic example last year of a dividend trap. If we look at one stage early last year, because it did pay a dividend in 2017, Myer, if you just looked at the historical yield, you would say it was trading at a 16% gross yield, so that's grossing up the dividend for franking, which is a fantastic dividend if you get it. But of course, the reason why it's trading such a high level of historic yield was because the share price had fallen, and indeed they cut their dividend completely. So we didn't hold Myer. It's actually now gone out of the index. And similarly, whilst we did grab a dividend out of AMP early last year, around this time last year, we then sold out completely and haven't held it since. And that share price has collapsed significantly. We all know the reason. So it has been an area, particularly when markets are weak, avoiding the really big underperformers is key. And it's interesting, we go back and look at our performance, and we actually do much better in down markets, avoiding those landmines. I just wanted to do one other, just a quick update, and then we'll have some time for questions, but an update on the ALP franking credit proposal, which is in the press almost every day these days. Just in case you have been on a desert island, this proposal by the ALP, they announced it almost a year ago in March last year that they would eliminate the net refund of franking credits to Australian investors But there are some exemptions. Charities, endowments, and Centrelink pensioners, if you receive an age pension or a disability pension, etc., from Centrelink, you will continue to receive the franking credit refunds. But self-funded retirees and self-managed super funds in pension phase will be the ones mainly hit by this because they currently receive it and they're not exempted. We've been participating, and there's currently a parliamentary inquiry into this proposal, which is quite interesting, having one government do an inquiry into the potential future government's policy. But we provided submissions to that inquiry, and indeed earlier this month, myself and Peter Gardner were witnesses at Bondi Junction hearing, so that was quite interesting. We put forward our case that we believe this proposal is very aggressive in that the less wealthy self-funded retirees are going to feel the most pain. The rich will actually not feel nearly as much pain. And it's also discriminatory because, for instance, self-managed super funds in pension phase won't be able to claim franking credits, but big APRA-regulated funds will continue to be able to provide franking credits to their members if they pay tax. So it is somewhat discriminatory, certainly discriminatory against pension phase self-managed super funds. It is a pretty contentious issue. There's something like 1 million people affected. In fact, I actually think it's closer to 2 million because the ALP hasn't counted everyone, I don't think. But because there are a lot of people affected, we do think it might be tough for the ALP to get this through Senate. So that is, even though they do win the election, they still have to get it through Senate. And as we saw with the corporate tax cut proposal by the current government, they were unable to get that through Senate. So given the contentious nature of this essentially tax on retirees, I think that it would be given a pretty good hearing in the Senate. However, as directors, we can't, we only have the evidence before us, and that was one of the main reasons for us declaring a special dividend, was to pay out some of those extra franking credits prior to the 30th of June. And as I mentioned before, there is a possibility that we may pay a larger special dividend depending on how many options are exercised or not exercised, is probably more the important issue. So just finally, in terms of outlook, we have seen a big turnaround in the interest rate expectations, and it does seem to be a low for longer situation with basically expectations of future interest rates here in the US now having gone away. So we're actually in a neutral situation here in Australia where the next rate rise could just as likely be down as up. The outlook for dividends, particularly for this half, still remain very strong. A number of companies have already announced special dividends or increases in dividends due to the ALP proposal. So a few LICs like ourselves have done it, but also we've seen companies of the likes of Woodside, Wesfarmers, and Flight Centre have all announced either specials or increased dividends, and one of the justifications is the ALP proposal. We've also got that special dividend from BHP, and there's potential for buybacks from Woolworths, which if they successfully sell their petrol stations, they may consider doing a buyback as well, like the BHP and Rio ones. So we continue to expect to see good income in the foreseeable future, particularly this financial year. We would say, though, there's a fair bit of political risk out there. We've mentioned one, the franking credit proposal change, but there are a couple of other changes that the ALP have flagged as well for investors. An increase in CGT tax rates by reducing the discount, and into negative gearing, that's for properties, but it's also for shares. And clearly we haven't got fully over this Trump trade war area. So, yeah, there is certainly some uncertainty on the horizon, but we still think in the immediate future dividends outlook is strong. So I now hand back to our operator for questions.
Thank you so much, John. If anybody would like to ask a question, press *1 on your phone now, please. So *1 on your phone. Thank you, John. Our first question is from Harry, and he's a shareholder. Go ahead, please, Harry.
Yeah, thanks, Don. Just wondering if there's any sectors particularly more likely to pay out special dividends in light of Labor's proposal.
Well, you need to have the cash and you need to and the earnings. So we still think the resources sector looks pretty ripe for those sorts of things. So Woodside has done it. I mean, Wesfarmers sold down their coal, so that was one reason they're able to do it. So, but the stronger sectors at the moment certainly are resource related, whereas some of the retail areas are clearly fairly weak at present.
Great, thanks.
Thank you, John. Our next question is from Ian Nicol from IT Nicol Super Fund. Go ahead, please, Ian.
Good result for 2018, and it's looking good for 2019. I was just wondering, I have seen presentations from you in relation to a global fund. Is it possible that you may have an ASX-listed global fund?
Yes, we do have a global unlisted fund at the moment, and yes, we have thought about whether, a number of people have sort of suggested we may want to look to list that fund in the future. So that's sort of something to watch. I mean, it's interesting, you look at the franking issue, if you don't get, the franking credits are the icing on the cake in Australia, but if they go away, then yields on global stocks will look more attractive, and we can generate around 6% income from that fund, from that global fund, which stacks up pretty well if you don't have franking credits in Australia.
John, we don't have any further questions.
Well, that's good. Hopefully all the investors are understood the message and dividends are strong. So, all right, I think we don't need to have carry on. So I'd just like to thank listeners this morning, and we'll keep on trying to deliver that strong income from PLA. Thank you.